You know what's frustrating about breakout trading? By the time your indicator gives you the signal, smart money's already positioned against you, so you're left buying the top before the reversal crushes you. But what if you could see where institutional traders are accumulating their positions before the breakout even happens? In this video, I'm going to reveal this powerful volume-based indicator, show you exactly how to spot real breakouts versus fakeouts, and give you the precise settings to use across any market. Let's get into it. To add this powerful indicator to your chart, first, head over to TradingView and pull up any chart you want. I'm using the 15-minute time frame on GBP/JPY, but this works on any market, any time frame. Click on Indicators and type in High Volume Points. Make sure you select the one by Big Beluga. Now, while most indicators just draw horizontal lines on your chart, hoping they'll hold, this one shows you exactly how much volume traded at each level. Let me show you what makes it special. You've got concentric circles that appear at pivot highs and lows, and the size of these circles? That's not random. Bigger circles mean more volume, more institutional participation, and inside each circle, you'll see the exact volume number. But that's not all. The indicator also draws horizontal levels from these high-volume pivots, acting as dynamic support and resistance. So when price crosses these levels and grabs liquidity, the line automatically changes to dashed, a visual confirmation that a liquidity grab just happened. Now here's the truth. Most retail traders never figure out. You can learn every manipulation setup I just showed you, but if you're manually staring at charts, you'll always be the last one in and the first one out. That's exactly why we automate everything: entries, exits, and risk management. Our traders run these exact setups fully automated across forex, crypto, and indices, and the results speak for themselves. Like Ethan, who got funded 3 different times using these systems, or Marion, who made $10,000 in just 10 days while still working full-time as a chef. These aren't what-ifs, they're real results happening inside our community every single day. If you want to see the live performance results and backtest data for yourself, click the first link in the description before the spots close. Disclaimer: this is for educational purposes only. Trading carries risk, and no strategy can guarantee results. Now, before I show you how to trade with this, let's get your settings right. Double-click on the indicator to open the settings panel. You'll see the pivot length setting first. This controls how the indicator detects swing points. I'm setting this to 10, which means the indicator needs 10 bars on each side of a turning point to confirm it as a valid pivot. Lower numbers give you more pivots but more noise. Higher numbers give you fewer pivots but more valid ones. Next is the volume threshold, which determines what qualifies as high volume. For most markets, I recommend you set it to 4, as this filters out average volume and only shows you the exceptional spikes where institutions are really loading up. Now let me show you how to use this to separate real breakouts from fakeouts. Phase 1 is to identify high volume accumulation zone first. You want to look for large circles with high volume numbers. I'm talking about circles that are visibly bigger than the others on your chart, and make sure they're at key structures before swing highs or swing lows, not random spots in the middle of nowhere. Once that's met, you've identified where institutions are accumulating. Phase 2 is to wait for initial breakout attempt, because that's where most traders mess up. They see price approaching that high volume level, and they mistake that as resistance and take a short position, or they see a small break above it and mistake that as breakout and take a long position. What you want to do instead is wait for something called the liquidity grab. When you see that line go from solid to dashed, you know the liquidity grab happened. That's your visual confirmation. Phase 3 is to enter on retest now. After the liquidity grab, price returns to test that level again. But now something's different. That level that was resistance before, it now becomes support. Why? Because institutions accumulated there, they grabbed liquidity. They shook out the weak hands, and now they're ready for the real move. When you see a bullish confirmation candle, a strong green candle closing back above that high volume level, that's your entry trigger. The high volume circle is still there, reminding you that institutional interest is at this level. The dashed line confirms liquidity was grabbed, and now price is showing you it's ready to move. Enter long on that confirmation candle. Place your stop loss just below that high volume circle. If institutions are wrong and price breaks back down, you're out. But if they're right, which they usually are when you see these massive accumulation zones, price is about to run. Here's what separates profitable traders from everyone else watching this video. Retail keeps chasing breakouts and getting dumped on, while institutions pocket the profits. You can master every manipulation strategy I just showed you, but if you're trading manually, you'll burn out long before you ever get consistent results. That's why we built automated systems that hunt these manipulation moves 24/7. No emotions, no missed setups, just results. Over 600 traders are already using these exact systems, like Dan, who made $9,000 in his very first month, or Steven, who shows consistent overnight profits while he sleeps. But I only take on 30 traders each month because I personally guide everyone through setup to make sure you're getting results. So if you're serious about finally trading with the institutions instead of against them, click the first link now before spots fill up. Disclaimer: this is for educational purposes only. Trading carries risk, and no strategy can guarantee results. Now, different markets require different settings for the best result. For forex pairs, especially majors like EE, UR, USD, and GBP JPY, set pivot length to 10 and volume threshold to 4. Forex has consistent institutional flow, so these settings catch the real accumulation zones without the noise. For crypto, drop pivot length to 8 and increase volume threshold to 5. Crypto moves faster and more violently than traditional markets, so you need faster pivot detection but higher volume filtering to avoid the constant noise. For gold, set pivot length to 12 and volume threshold to 5. Gold is notorious for fake breakouts and whipsaws, so higher pivot length gives you more significant swing points, and the higher volume threshold ensures you're only seeing truly exceptional institutional activity before those explosive moves gold is famous for. For stocks, keep pivot length at 10 and volume threshold at 4. Watch for high-volume circles appearing around earnings announcements or major news events. These often mark accumulation before significant moves. Thanks for watching, and I'll see you in the next one.